going into January this year, I was quite bullish. Phase one deal coming up, liquidity was flush. They just cut interest rates, right? Because they started QE again.
Correct.
And economic data was improving, right? Profits were growing. And this goes back to the risk management framework. So when I look at my portfolio, I need to see where the tail risks are, right? You need to understand that things are looking rosy. What happens if things change? So I put it through a scenario analysis, and I noticed that one of the tail risks for me was a black swan event, a meltdown in markets, right? I didn't believe it was going to happen. I didn't see what was going to happen. Yeah. But I just bought some cheap options because options were cheap then. No one wanted to hedge anything. Everyone thought.
And this is the whole point of tail risks. You don't want them to happen, right?
Correct,
but you do still hedge, right? Yeah.
So I bought some cheap puts on the S&P just as a macro hedge for the whole portfolio.
Correct.
And China shuts down, locks down the 23rd of January, right?
Yes.
And things changed. And so with me, the first thing I did was ask everyone around, like doctors, people in China, what was going on. And I realized that, okay, a 1 month lockdown in China, second biggest economy in the world, growth is not going to keep going up, right? Yeah. So I got rid of all my, cyclical exposures in North Asia. And I decided to get a bit more duration, more bonds in there, because slowing growth means you want to be long government bonds. Yeah. I didn't take off my equity puts because I didn't know how bad this could get.
Correct.
And in February, when you saw how bad it spread in China, I started to get a bit more bearish, but still not as bearish because people in Europe and the US.
There was a real disconnect, right? People were kind of acting like it's just those crazy people in Asia who eat bats or whatever it was they were saying. And I was like, I was just a bit kind of, gobsmacked, to be honest, right?
Yeah. And being here, we were lucky because we saw it firsthand, right?
Yes.
And we've had SARS here before as well. Right?
Exactly. Yeah. And you talk to your counterparts in in Europe and the US, they were like, nothing's wrong. Right up to the end of Feb. And what I noticed is because you can also, I do keep track of positioning data.
Sure.
So I pay for that to just see how the markets are generally positioned. And the biggest tail risk in the market, we had the highest positioning in equities in the last 10 years in February, after we had a lockdown in China, which, so that was a bit of a disconnect, right? The risk was there. Yeah. So once they had the first few cases in New York and it started becoming a problem, that's when I started getting bearish. So when I look at regimes, I felt there was a high chance we were going into a deleveraging regime. Yeah. In that situation, nothing goes up except the US dollar. Right, so I shifted my portfolio from constructive in January, defensive in February, and March I went to the deleveraging. Right, so I was long the US dollar, short the S&P. I left my puts there. Yeah, it was the best 10 basis points I spent.
Yeah, absolutely. And then also the structuring of that, right? Because being directional short on equities it's really tough over extended periods of time to hold it. Right?
Yeah, because what I noticed was the liquidity again, right? Yes. So I think the move in March was not fundamentals, it was more liquidity. People needed to get out, and there was no liquidity. Yeah. The liquidity in S&P futures and Treasury futures were 5% of the regular liquidity, right? So you imagine these big multi-billion-dollar hedge funds that need to liquidate.
And that's why we had the moves that we had in March, basically.
Correct, right? Correct. And so my idea there, because I'm always putting my portfolio based on regimes, right? Yeah. So when I was short there, I told myself the minute the Fed comes out, because it's a liquidity problem to me, it wasn't the virus, right? People were getting out. Yeah. So I said, when the Fed comes out and backstops the Treasury market, I'm going to reverse my positions.
Gotcha.
Right, so they came out third week of March. I think it started on the 18th, and they kept announcing stuff for a month. Yeah. But they backstopped the Treasury markets first, and that was the spot when vol started to collapse in the Treasury market, and I went long duration there. Yeah. And then they said they're going to backstop corporate bonds. So I started buying investment grade bonds in the US. Yeah. Then they said they're going to backstop mortgage bonds, mortgage securities. I bought those. So the idea was to front run the Fed. Yeah, right?
Yeah. I still remember they were really quick because I remember you and I talking about like credit is next on the weekend, and we still thought it was maybe 2 weeks, and it ended up being the Monday that opened up, right?
Yeah. So I think you know how they react. Yeah. The central banks are going to come in and stabilize markets, right? Yeah. So you want to be with them, don't fight the Fed, as people say. Sure. So then we rode that over March, April, and May. There were a bit of divergences. You were still short EM, short oil going through that period, but you're getting more constructive on bonds, for example. So I think it was just the framework, just sticking to the game. I didn't do anything differently in this year than I would have done last year.
Yeah.
It's just knowing what regime you're in and what you need to trade.